Welcome to today's video. First, we'll uncover how high broker fees and actively managed fund costs can quietly drain your wealth. Then, we'll show you a practical, step-by-step path to switch to low-cost index funds without missing a beat. Throughout, we'll emphasize taxes, transfer mechanics, and a simple allocation that fits long-term, high-risk tolerance investors. Here's the plan. First, we'll expose the hidden cost of fees. Next, we'll outline a simple low-cost index strategy. Then, we'll walk through the exact transfer steps. After that, we'll cover taxes and their implications. Meanwhile, we'll propose a straightforward portfolio. Subsequently, we'll quantify the impact with case studies. Finally, we'll wrap up with risks, caveats, and a checklist. To begin, many investors delegate to high-fee brokers and active funds, paying loads and steep expense ratios. Consequently, a portion of their return is captured by fees every single year. Over decades, that consistent drag compounds and can amount to 7 figures in opportunity cost. Therefore, recognizing fee drag early is crucial for long-term outcomes. Next, let's define fee drag. An expense ratio is taken from the fund annually, which reduces your effective growth rate. For instance, if the gross market return is around 7%, paying 1.5% leaves you with 5.5% before taxes. Conversely, paying 5 basis points leaves about 6.95%. Over 30 to 40 years, that difference compounds dramatically. Thus, the goal is to minimize costs, so compounding compounds your gains, not the fees. Now let's visualize the target portfolio allocation. The pie shows a simple two-fund approach. 85% in a total U.S. market index, and 15% in a total international index. This creates broad diversification with minimal complexity. As we transition to implementation, keep this target in mind as your consolidation destination after the transfer and liquidation. Moving on to execution. First, open a taxable brokerage and a Roth IRA at a low-cost provider. Second, request an in-kind transfer, often handled via ACAT, from your current high-fee firm. Third, understand that proprietary or restricted funds may not transfer in kind and can be converted to cash. Fourth, once assets arrive, promptly liquidate the old holdings, bearing in mind capital gains in your taxable account. Fifth, deploy the proceeds into your target allocation, 85% total U.S. and 15% total international. Sixth, automate contributions and set periodic rebalancing reminders. Seventh, write a simple investment policy statement to promote discipline through market cycles. Here is the flow of actions. First, you open accounts at a low-cost provider. Next, you initiate an ACAT transfer in kind. If the system detects proprietary funds, those holdings typically convert to cash during the transfer. Then, assets arrive in your new account. Immediately after, you liquidate old positions, recognizing that doing so in taxable accounts can trigger capital gains taxes. Subsequently, you reinvest into your two-fund allocation. Finally, you automate contributions and establish a periodic rebalancing routine, completing the consolidation process. Before we sell, we must understand taxes. In taxable accounts, selling appreciated assets generally triggers capital gains taxes. In contrast, moving a Roth IRA via a direct trustee-to-trustee transfer is typically tax-free, avoiding any withholding or rollover pitfalls. It's usually best to avoid a 60-day rollover and instead use a direct transfer to stay compliant. Plan sales with capital gains in mind, using appropriate lot selection and timing where possible. Moreover, keep detailed records and consult a qualified tax professional for situations specific to your circumstances. Quiz time. The question is, which account move is generally tax-free when done trustee-to-trustee? Option A, selling appreciated stock in a taxable brokerage. Option B, moving a Roth IRA via direct transfer. Option C, liquidating proprietary funds inside a taxable account. Option D, rebalancing by selling winners in a taxable brokerage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, moving a Roth IRA via direct transfer. This is generally tax-free, whereas selling inside a taxable brokerage can trigger capital gains. Liquidating proprietary funds in taxable or rebalancing via sales and taxable can both create tax liabilities. Let's quantify. Consider a $100,000 lump sum invested for 30 years at roughly 6.95% net. Consistent with a near-zero expense ratio, the ending value is about $751,000 at 5.5% net. Reflecting a 1.5% expense ratio, the ending value is about $502,000, a difference near $249,000. Now consider contributions. At $2,000 per month for 35 years, low fees can compound to about $3.28 million versus roughly $2.41 million at high fees, a gap close to $870,000. At $3,000 per month for 40 years, the difference widens to more than $2 million. These are simplified, hypothetical estimates for illustration only, but they demonstrate the massive effect of fee drag over long horizons. This table summarizes the hypothetical outcomes. For a $100,000 lump sum invested for 30 years, the low fee path ends around $751,000 versus about $502,000 for the high fee path. For $2,000 per month contributed over 35 years, results are about $3.28 million versus $2.41 million. For $3,000 per month over 40 years, results are about $7.09 million versus $4.94 million. Differences are substantial and illustrate how lower fees can produce significantly higher terminal wealth. Let's compare. Active funds typically carry higher expense ratios, sometimes with loads, manager risk, and potentially tax-inefficient turnover. Moreover, many active strategies lag indexes after accounting for fees. In contrast, index funds usually have ultra-low expense ratios, no loads at reputable providers, broad and rules-based exposure, and tax efficiency. Consequently, index funds frequently deliver competitive long-term outcomes with less cost and complexity. As we proceed, it helps to codify a simple, one-page plan. State a long-term growth goal. Note your risk tolerance is high if appropriate. Specify a low-cost index strategy with the 85% U.S. and 15% international allocation. Automate monthly contributions, and define rebalancing either annually or via threshold bands. Additionally, outline your tax practices and remind yourself to avoid performance chasing and to stay disciplined through volatility. To structure your execution, the timeline begins in week 1 with selecting a provider and opening accounts. In week 2, you submit the ACAT transfer in kind. During weeks 3 and 4, assets move, and any proprietary funds may convert to cash. In week 4, you liquidate and reinvest into your 85-15 allocation. By week 5, you automate contributions and establish rebalancing reminders. Thereafter, you conduct an annual review and integrate tax planning. Before we conclude, consider risks and suitability. Broad index funds are still subject to market risk. Additionally, discipline is required to avoid style drift and performance chasing. Tax timing matters, because realizing gains can create liabilities, so plan exits deliberately. Some assets may be restricted and convert to cash during transfer, requiring prompt reinvestment. Finally, the 85-15 allocation is intended for long-term investors with high risk tolerance. Those with different needs should adjust accordingly. Here's another quick check. What is the recommended final step after reinvesting into your 85-15 allocation? Option A, stop contributions. Option B, automate contributions and set rebalancing reminders. Option C, increase fees. Option D, move everything back to the original broker. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B, automate contributions and set rebalancing reminders. This creates a consistent saving habit and maintains your target risk level through time. Here are the key steps to complete before and during your move. Open low-cost taxable and Roth IRA accounts. Initiate an ACAT or transfer in kind and note any proprietary fund constraints. Plan for taxes on any necessary sales in your taxable account. Consolidate holdings into the 85% U.S. and 15% international funds. Automate contributions and rebalancing. And write down your investment policy statement to maintain discipline. Before we finish, a quick disclaimer. This content is educational and not financial, tax, or investment advice. The scenarios and figures are simplified, Hypothetical examples. Your situation is unique, so consult a qualified fiduciary advisor and a tax professional before implementing any strategy. To summarize, high fees quietly erode long-term returns. In contrast, low-cost index funds allow more of the market's compounding to accrue to you. Execute a clear transfer plan, reinvest promptly, and pay close attention to tax implications, distinguishing between taxable and Roth accounts. Finally, automate contributions, rebalance periodically, and maintain discipline. Thanks for watching. If you found this helpful, please like, share, and subscribe. Also, tell us in the comments what step you're on in your transfer journey and what questions we can address next.